So we're going to have a look at the 2020 marginal costing question from the mock exam, question 8. Um, this is a fairly straightforward part A of this question with one or two little tricks, a standard marginal costing question with a couple of little features, and then part B is a new part which we need to examine as well. I've already done a video on the 2011 question where I went into detail on how to do the base variable cost and the setup. So therefore there is some assumed knowledge here, and I'm going to go through this relatively quickly, just touching on the new information in the question. If you wish to revise a standard marginal costing question first, then I recommend you look at the 2011 marginal costing video to see that. So the question says Deal Limited produces a single product, and the company gives a profit and loss account here for 80,000 units, and it gives you materials, labor, factory overheads, administration, and selling expenses. Now we know that we need to set up the information first, and we need to do the preparatory work here before we can tackle part 1, 2, 3, 4, 5 of the question below. So therefore, the setup is the same every time for a marginal costing question. You need to divide all of these overheads, and you're given 5 of them in the question. You need to take all 5 of these, and you need to split them between variable and fixed so that we can get a total for variable and a total for fixed. So the question tells us, for example, that materials and direct labor are variable overheads. So therefore, these two, we are safe to put those in as variable overheads. The question tells us, I'm just going to skip forward here, the question tells us that apart from a sales commission of 5% on sales, the selling expenses are fixed. So therefore, how you do that is you get 5%, I'm just going to follow this over, 5% of your sales is variable, the remainder is fixed. So that is 5% of 1,920,000, which gives you 96. And then you take that 96 away from the 125, away from the 121,500 in the question. And that will give you that 25,500 as the fixed component of selling expenses. The question says administration expenses are all fixed, so therefore we can simply put that 125 in the fixed column. But I need to go back and talk to you about the factory overheads. The factory overheads, the way they give this information here, they're testing the students' knowledge of flexible budgeting. So they tell you factory overheads are mixed cost and have prepared they have behaved, in the past as follows. And they give you the last 3 years, and they give you the outputs, and they give you the factory overheads. And what you're asked to do here, and it says in question part 1, it says calculate the variable and fixed elements of the factory overheads using the high-low method. Of course, the high-low method is a direct hint to use flexible budgeting. So here is our high-low method over here, where you have to say that in the highest and the lowest, and then the difference between them. In units, the highest for the 3 years is 90,000, and the lowest is 55,000, giving you a difference of 35,000. And in money terms, the highest is 300,000, the lowest is 212,500, giving you a difference of 87,500. We then can divide this 35 into, because we can say that the variable cost, or the difference in cost of 35,000 units, is 87,500 euro. Therefore, the variable cost of factory overheads is 87,000 divided by 35,000 units, or €2.50 per unit. And then the remainder is fixed. Now, that is part A, or part 1 answered, but more importantly, you bring that information back over to here. Now, how many units do we have for this particular company, Deal Limited? This year we have 80,000 units. So this 200,000 is now 80,000 multiplied by the €2.50 per unit. And that will give you 200,000 variable And then the remaining 75 from the 275 in the question is the fixed component. A little bit of flexible budgeting within a marginal costing question. Of course, you can review the video on flexible budgeting if you want a reminder on how to do a high-low method again. This gives you your variable and fixed costs, and which we can then go down and have a look at our second preparation work. We have to do our marginal costing statement, which is sales, take away variable cost gives you contribution, take away fixed cost gives you the profit. These are the numbers for the total now. Given the question, 1,920,000, here's our 904, which you take away to get your contribution. Here's your 225,500, which you take away to get the profit. And then the per unit numbers, well, if you divide this by 80,000 units, you'll see that each product actually is sold for €24. There is a variable cost, perhaps electricity or materials or wages, and that is €11.30, which leaves a contribution of €12.70 per unit to cover fixed costs and to be left towards profit. 12.70. Now, I've explained this before in a previous video, but the variable cost, we need to do a little bit of work on this over here to see what the base variable cost is. So the variable cost currently is 11.30, but of course we know that that includes 5% of the 24 or the selling price. Therefore, if you remove that, you'll find that the base variable cost without any 5% is €10.10. And there's an NB point here to say that as the selling price changes by €1, the variable cost will change by 5% of €1, which is 5 cents. And that rule still applies, assuming it's still 5%. Could be 6%, and then it would be 6 cents of a change. The base variable cost is important, and we'll use that in part 3 and 4, and I think 5 of this question. Now, let's have a look at part 2 and 3 going forward now. Of course, part 2 asks us, it's traditionally part 1 of the question, but part 1 here was involved in the setup. So part 2 of the question says, calculate the company's break-even point and margin of safety. Well, the break-even point is simply the fixed costs, 225,500, divided by the contribution per unit, which I'll just show on the screen here, €12.70. You divide that in, and you'll find that this company has to produce 17,756 units to break even, always round up to the next full unit. Beyond that, they make a profit, which of course, they're far beyond that. They're selling 80,000 here, hence the profit of almost 800,000. The margin of safety, well, they have a significant margin of safety here. You take your sales and take away your break-even point, and they could afford to drop 62,244 units before they would be in danger of making a loss. And so that's the margin of safety. Straightforward part 2 here. Part 3 of the question says, calculate the company's profit in 2020 if it made a number of changes in its makeup. So let's look at this. It says that the sales are going to be as follows. Now, they're going to increase the number of units by 10%. So that brings that from 80 up to 88. And they're going to reduce the selling price by 5%. So therefore, our €24 becomes €22.80. And when you multiply that out, you get 2,006,400. Now, the variable cost, well, that is at 88,000 units again. Now, where do we get this 1124? Well, we get that. That is the base variable cost of €10.10 with no 5%, adding on 5% of the new selling price, which is €22.80. And when you add 5% of €22.80 to 10.10, I think that works out to be €1.14. And when you add that back on, that €1.14 back on to 10.10, you get 1124. That 1124 multiplied by your 88,000 units gives you this variable cost. You take the variable cost away, from the sales to get your contribution. And of course, then you take away your fixed costs. Now, the question instructs that the fixed costs are go up by 15,000. So you just add 15,000 onto your 225,500 to get 240,500, and you take that away to get your profit. And your profit is 776,780. Part 4 of the question. Here's where we use our algebra technique. It says in the question, calculate the number of units that must be sold at €27 per unit to provide a profit of 20% of the sales revenue from these same units. So we let X equal the number of units. And we can say to ourselves here that the sales, therefore, are going to be 27X. The variable cost is going to be 1145X. Now, how did we get that? Well, that is the base variable cost adding on 5% of the new selling price, which is 5% of 27. Of course, also you could say that here the selling price is going up by €3 from an original of 24 up to 27. So therefore the base variable cost, or sorry, the variable cost will go up by 15 cent, which is 5 cent per euro, a €3 change. 15 cent from 11.30 up to 11.45. Safer to know how to do the base variable cost, however, because of course up here the increase was not even euros, so therefore we needed to do it as such. Our fixed costs have not changed. They are 225,500, and our profit, well, that's an interesting one. That 5.4x, that is 20% of the sales. So 20% of 27 is €5.40. And then you solve for x, and you're going to get 22,217 units. Was the answer here. And then finally, we have question part 5. And part 5 is asking us to work out the selling price the company must charge per unit in 2020 if fixed cost increase, but the volume of sales units and profit remain the same as last year. So therefore, we have to start at the bottom here, and we have to say that this profit remains the same, 790,500, the same as the original question. The fixed cost increases by 15%. So therefore, if you take your 225,500 and put it up by 15%, you're going to get this number here. And we're working backwards here. So you add these two to get your contribution of 1,049,825. We're going to transfer that into the per unit column by dividing by 80,000. And you will find here that the contribution is 1312 per unit. Now, here is where you have to be cognizant of your base variable cost, because we cannot know what the variable cost is, because the variable cost includes 5% of selling price, and of course we don't know what the selling price is. So therefore we must go without that. We must put in our base variable cost, which is without any 5%. And when you add that up, you get 23.22. And we know that that is the base variable cost without any 5%, or in other words, 95% of the variable cost, so, or of the selling price. So therefore, if you divide that by 95 and multiply by 100, your selling price will be 24.44. And that 24.44 is 44-cent increase on the selling price in order to cover the increased fixed costs and yet retain the same level of profit at the same level of production. That is part A of the question completed. We're just going to have a quick look at part B, which is about a company called Galvin Limited. Now, part B of this question is really all about an idea called the contribution sales ratio, or the CS ratio, contribution to sales ratio. And you use the contribution to sales ratio. I'm just going to highlight this sentence here first off. You use the CS ratio when we do not know the number of units and therefore we cannot find the contribution per unit. It can replace the contribution per unit in formulae, but it will give its answers in euro rather than units. So if we do not have the units as a piece of information. Now, the question gives us the full marginal costing statement. It tells us our sales, our variable costs, tells us our contribution, our fixed costs, and our net profit. So therefore, it's quite easy for us to work out the contribution to sales ratio, because that is simply the contribution, which is 432, divided by the sales, and that is 60%. So what that means is that of all of the sales, the variable costs are 40% of the sales, and there's a 60% contribution, which goes towards covering fixed costs, and it goes towards a net profit for the company. That 60% figure is the CS ratio, and that's what we will use in part 1 and 2 of the question. So part 1 of the question, it says, using the contribution to sales ratio, calculate the company's break-even point in sales revenue. It's the same process, except instead of using the CPU, you use the CS ratio. So therefore it is fixed costs divided by the CS ratio, which is that 60%. And when you do that on your calculator, you will get a break-even point in sales revenue of 180,000. And that is the amount the company needs to sell in order to cover its costs. There, of course, is our current sales, so they'll have to sell much more than that to cover and break even, cover all of their costs. Now, then we can proceed to part 2, which asks you to calculate the sales revenue that will produce a profit of 436,000. That is a target profit. So we simply use the target profit formula that we have seen before, and it's explained in the 2011 video also. So therefore, we're just factoring in this target profit into the break-even formula. So it's 108 plus the 436 divided by 60%. And that gives you sales of 906,667. It needs to be rounded up to the and that is the sales revenue, actually, not units. I'm just going to make that change. Revenue. The sales revenue needed to be sold in order to achieve this profit. So therefore, if we wish to have, now we know that the profit currently is 320. So if we wish to have a higher profit of 436, we will need a higher sales. So logically, this looks like this answer is correct here. So that's the target profit formula using the CS ratio. And then finally, we have part 3, which is basically just a rationale. It says, for what purpose is the contribution to sales ratio regularly used? And when is its use essential? Well, it says the CS ratio can be used when we do not have the number of units, and therefore we cannot find the contribution per unit. It can replace the contribution per unit in formula, but it will give its answers in euro, not in units. And that's essentially what I've written up here. I've just moved that down. So that part B is leaning very heavily on an understanding of the CS ratio, the contribution to sales ratio, which essentially is another way to calculate break-even point or target profit if you are not given the contribution per unit.